This is Robert Kraft, and I'm your host for the SNN.Network virtual conference. Thank you all for being here and joining us today. I'm very excited to introduce one of our keynote speakers for this event, Connor Haley. He is the founder of Alta Fox Capital Management, good friend now for a few years, and just really excited for him to share with you this topic for the keynote, which I'll give you a high-level little tease right before we get into it, and it's Connor's really going to be talking about groupthink among hedge funds and allocators in the hiring process. And what are some of the implications for the asset management industry? Nice. With that, Connor Haley, here he is, and enjoy.
Great. Thanks a lot, Bobby. So I run Alta Fox Capital Management. It's a long-short hedge fund based out of the Fort Worth area. We focus primarily on small and microcap stocks. I've also been a member of MicroCap Club for a long period of time, known Bobby for a while. So, this is a topic that I'm pretty passionate about. So I'm excited to share some of my thoughts, which, I think I potentially have some interesting views on given my experience. So I've sort of gone through a somewhat traditional path in the sense that, I went to a target school, I, interned at Goldman, I worked for a big hedge fund. I've sort of seen that, and a lot of my friends followed that same path. But at the same time, I've also seen another side of sort of the investing community. I've been really involved with MicroCap Club. I've been really involved with Value Investors Club. I worked at the Motley Fool for a little while. So I've seen sort of the sort of retail investing side, the individual investor side. And I think having both of those perspectives has influenced how I think about this topic today. So I'll just jump right into it. So, really the impetus for thinking about this question is, this industry is full of a lot of really smart people, and every fund claims that they have an edge, right? Every fund claims that they're thinking about things in a different way. Yet when you step back and you think about what are the most important assets that a fundamental investing shop has, it's there's really very little there. It's the people, right? It's the ideas, it's the talent. And despite that, I find that many funds are putting very little effort into thinking about how they can get a competitive advantage in acquiring talent and managing that talent, incentivizing that talent. Because the reality is most funds recruit from the same investment banks, right, that are recruiting from the same set of schools. They rely on the same set of headhunters. And there's a lot of groupthink there. There's very little differentiation among the majority of funds when they're looking to hire an analyst, when they're looking to bring somebody on. So should it be a big surprise that these, traditional funds are achieving in aggregate sort of similar and below average results? Today I'd sort of like to flesh out some of those points, some of the issues that I think plague the hiring process in the industry, why I think it often leads to poor results, and the implications for hedge funds, allocators, and also the next generation of investment talent, because I think there's a lot changing. So what's wrong with the current model? So why are hedge funds recruiting from a very small set of banks typically, which then on their own recruit from the same set of schools and use the same set of headhunters? Why is this happening? Well, I think from a hedge fund's perspective, in their minds, there's not a great way to differentiate candidates. And so what do you rely on? You rely on brand name, right? What school did they go to? What was their GPA? These types of things. And with significantly more demand than supply in this labor market, why not focus on the best resume is, I think, kind of the point. And there's another element to this, which is there's a lot of pressure from allocators, right? There's the saying, right? You never get fired for buying IBM, right? That same analogy extends to picking funds as well. And so, I think if you hire the, fund that's been around for 20 years and they've got a bunch of Harvard and Wharton MBAs, even if they underperform, whatever, can anyone really blame you for picking them? I think that sort of IBM analogy extends to the allocator community as well. But I think there's a lot of problems with this approach because it leads to bad incentives, right? So I've seen it. I saw a lot of, a lot of my classmates at Harvard, picking different classes, like trying to really tailor their resume to what people wanted to see, whether it was the investment bank or the investment firm, and they're not trying to become a better thinker. They're not trying to become a better even investor. They're just trying to play the game. They're trying to win this game of perverse incentives that has been set up by multiple layers of this industry. And so, um, kids go for the best GPAs by taking specific classes. They memorize all the investment banking questions right ahead of the interviews. But I think that tells you very little about the investing potential of various candidates. And I think there are a lot of problems with this approach. So what you end up getting is you get sort of they call it sort of a model monkey in investment banking, right? They just model all day long, like there's very little thought into it. Then you go to a hedge fund, and it's often sort of the same thing. When are you actually investing in their development, right? When are you actually exposing them to the investment greats? When are you having them read sort of all the, Buffett partnership letters, Greenblatt, Lynch, all these investing giants from which there's so much to learn. I think there's a real hole there. And I think there's an interesting essay called The Playing Field, which was written by a guy named Graham Duncan, who works for an allocator. And he talks about the various stages of investors and how they progress over time. And I won't get into the weeds of it. It's an interesting article if anyone wants to read it. But the very first step he sort of suggests is this apprenticeship model, right? Where you go, you work for somebody who's more experienced, you learn a lot from them, you adopt, certain aspects of their style, and that's the very first step. And then from there, you try to sort of master the game. I think there's a lot of issues with this model as well, right? And so the idea that, to become a great investor, you have to work for one, I think is really flawed, right? I think ultimately, and it's really a pessimistic view of the industry, right? Because if you really have a passion and desire to become a great investor, it's a somewhat pessimistic view that you have to, one, go find a great investor to work for and agree for him to let you work for them, right? Him or her, which is difficult. And then number two, even if you do land that coveted seat, what are the odds that they're actually going to be a capable and willing mentor for you to pass that on, right? I think very low. And so what do you do if you're not in that sort of rare coveted seat where someone will teach you everything they've learned? I think the reality is there are more tools today to learn about investing than ever before, available for free online, right? You want to read Joel Greenblatt's Columbia Business School notes, they're out there, right? You want to, read all the Buffett partnership letters, there are sites that compile them. There's so many resources out there that frankly weren't around 20 years ago. And so rather than rely on fate or luck to learn from someone who will agree to pass down certain lessons to you, I think you should really seek out mentors from the past, right? Warren Buffett in his partnership letters, you can read a lot from that. Greenblatt, Lynch, all these people I mentioned, you can learn from them, and in that sense, you get the greatest mentors you could possibly have, and then you can form your own style. So I think this apprenticeship model is dying, right? Particularly because high quality talent wants to spend less and less time at investment banks rather than a 3-year program and a 2-year program. People are leaving earlier, hedge funds are recruiting earlier, and I think there's a reason for that, and it's because the ability for an individual to accelerate their learning by learning from the investing greats of the past is unprecedented. It's greater than it ever has been, and I think if you're really serious about investing, you should get into that as early as possible. And I think there's an interesting sort of chess analogy here as well, right? Because I think there's a bit of this sense in investing that to become a really great investor, you have to see all these full market cycles, right? You got to go through the ups and the downs and all these different things. And I'm not discrediting that. There's certainly, it's valuable to have that type of experience, particularly on the emotional side. However, I think if you look at, say, chess players, right, they tend to peak in like their late 20s, early 30s, right, early to mid 30s. So sort of the gray-haired guys, are actually in sort of cognitive decline. And I think investing is also a very cerebral pursuit. And I think there are case studies out there as well in investing. So you can learn from the mistakes of others rather than having to, live through all of it yourself. Because the reality is, if you don't ever spend time studying the investing greats, if you don't ever spend time really, writing your own blog, trying to research different ideas, basically trying to build up pattern recognition through case studies from the past, then when you eventually get to some investment, seat, you're on sort of your first repetition, right? And even if you're really, really sharp and you work very hard, you're not going to have enough sort of at bats. You're not going to have the pattern recognition to make the right calls. And so you sort of have two options. One is you can work for 30 years and build up that experience, one actual investment case at a time on the job, or you can do all of that in advance, right? By learning from the past. So I think really the idea is utilizing case studies, lessons from past great investors to accelerate your pattern recognition, to accelerate your development, and ultimately get to the sort of best seat possible for you. But getting sort of back to some of the hiring implications in the industry. So if you think about hedge funds, it's interesting. There are some notable exceptions for funds trying to think outside the box, but they're very much the exception to the rule. So one I'd point out would be Point72, for example, managed by Steve Cohen. So they started in the last 5 years, I want to say, this Point72 Academy, I think it's called, where they recruit directly from undergraduate schools. So they're bypassing the investment banks. They're hiring interns. They're putting them into a formal training program. They're letting them run sort of mock portfolios. They're trying to see who has potential and develop them into their own sort of skill set. I think that's really innovative. I think that's really cool. I think they're likely to have a lot of success doing that. I think, Point72 is a very large fund. Not all funds can sort of employ that model at scale. That being said, there are other ways to do it. I'll give you an example from my fund. So, a couple of years ago, I sponsored an undergraduate investment competition. I did it through the Harvard Financial Analyst Club that I had a relationship with during my time there. They helped blast it out to basically every undergraduate school in the country. And, I was overwhelmed with the responses. We had over, I think, 70 schools apply. We had over 150 candidates, and all different types of candidates, very, a lot of diverse candidates, like a lot of people that, often you may not have seen through a traditional channel. And it was totally based on the quality of your idea. It wasn't based on your resume. It wasn't based on your GPA. It wasn't based on your school. It was send in your best small cap idea. And we reviewed every single one, right? We whittled it down to the top 15 schools, and they came out to Harvard for one day, right? And we had a finals competition, had a couple friends come up and judge it. And it was a great experience. And out of that, I had several interns work for me during the year, and I ended up hiring my analyst from that project, right? And that was a really great experience. But there's a lot of talent out there, and it gets better every single year because more and more people want to get into this industry. They're starting earlier. There's so many resources, and there's a lot of talent. And so I think that's a much more creative way of finding people who are really passionate about investing and really want to succeed than finding someone who has tailored their resume to get the right investment banking job, who tailored their resume to get the right hedge fund job. That person may be great, maybe not, but I'd rather go with a person who's super passionate about investing and has already started trying to accelerate their development by reading as much as possible from great investors. So, I think so that's sort of the implications on hiring from a hedge fund perspective. There are also implications for allocators, I think. So, I think allocators should really look to expand their horizons to non-traditional candidates, right? Emerging managers, right? There's a lot of research out there that suggests, smaller, more nimble emerging managers put up better returns than larger, more established managers. Yet, a majority of assets in the industry continues to flow to the largest managers. And I think, it goes back to that IBM analogy. But I think really allocators should be challenged to think outside the box, consider non-traditional candidates, consider emerging managers, because I think the returns will be better for it and it will lead to sort of a more diverse pool of talent in the industry as well. I think there's implications for aspiring investors, which I've somewhat alluded to. So it's really, don't rely on a mentor or a program, right? Take your own development into your own hands. The odds that you get some great investor who is really, willing and able to teach you everything they know is pretty slim. But the good news is you can still learn a ton just from studying investors from the past, and it's completely free. There's so much out there. I was mostly self-taught, and I learned a lot from just reading basically every Value Investors Club post that went up 5x or more. Studying the comments, like getting so many sort of repetitions, developing my pattern recognition. I think there's so many resources out there, and so you really don't have an excuse if you want to become a better investor. There's so much out there, sort of just get after it. So sort of in conclusion here, I think my sort of overall takeaway is, look, the only asset investment managers from a fundamental perspective really have is their talent. You need to be really creative and thoughtful about how you acquire that talent, right? How you recruit them, how you train them, how you incentivize them, how you train them over time as they develop. But I think there are implications for allocators. You don't always have to go with the fund that's been around 20 years. There's a lot of talent that doesn't get enough attention from non-traditional sort of candidates and molds, and I think your returns will be better with sort of smaller, emerging, more nimble funds. And then finally, as an individual investor, so many opportunities to learn. Study Greenblatt, study Buffett, study Lynch, study the investing greats, and you'll sort of be well on your way. Frankly, be well ahead of candidates who just went the traditional route and never took the time to learn from the past and learn from the investing giants. So I'll sort of pause there. I think returns would improve. I think diversity would improve. I think the industry would be more meritocratic. The last thing I'd say is, just blogs, right? There's so many talented people out there who run blogs, right? And a lot of them have really unusual backgrounds, right? I think that's great. I think that's really cool. I think a lot of those people, frankly, are more talented than many well-pedigreed hedge fund analysts that I've seen. I think just have a passion for it, get after it, and I think there's a lot of opportunities for smart funds to pick up great candidates who maybe don't fit that traditional mold.
All right, that's a great. Thank you for that. I had a couple questions to follow up with. The first big one, my huge takeaway here: what school won the competition?
I don't remember. I don't remember which school won. So I ended up hiring my analyst from Northeastern, right? Not a target school, right? There were candidates from all over. So, we had Ivy League schools there. We had non-target schools there. It was sort of all across the board. But I think that was the point, right? Is there's talent everywhere. And, I think that's, it's unfortunate that a lot of really talented and passionate candidates are excluded from a lot of interesting roles because the industry has outsourced the responsibility of talent acquisition, right? Hedge funds essentially outsource it to headhunters who have somewhat outsourced it to investment banks, right? Who are hiring at a very small set of schools. And it leads to this chain reaction where, the really talented, passionate kid at a non-target school has a really difficult time, finding the right role. And I think the industry can do a better job of identifying those candidates. I think some hedge funds have already started, but I think all funds are really incentivized to take that more seriously because talent is the only asset you have.
I couldn't agree more. And especially on your point about diversity, we talked about this on a few panels already for this show. And by having a more meritocratic system, sorry, I knew I was going to butcher that word, so I had to say it slower. But by having a more of a meritocratic system, it really opens things up because you're getting in submissions on small cap ideas from you. You don't even need to see a name. You just want to see the idea and understand how they're thinking. And that's what you're really looking for at the end of the day. You could care less who the person, I mean, we always care about who the person is, but when it comes to where they're from, their background, you just want to see the work.
100% couldn't agree more. I think, yeah, if you make it more meritocratic and if you set up a pipeline for candidates who are really passionate and want to succeed, I think there's so much talent out there that really doesn't get a fair shot. And I think that's unfortunate, but I also think it's an opportunity. It's an opportunity for funds. It's it's an opportunity for allocators. So it's an opportunity for them to ultimately, I think, achieve better returns in a way that's more meritocratic, like you mentioned.
No, not to be to make this about me, but like one of the cool things that I've had about even Planet Microcap, my podcast, is that I've had on people that, full-time microcap investor that you would have never heard anywhere before, but are brilliant, and have a really unique, different way about their investing strategy and looking at the markets. And, it's what's amazing about our digital age is being able to open up what more opinions and more ways in which you can do things and accomplish things and be successful. You don't have to go the Harvard route to become the next Jamie Dimon or something of that sort. I mean, I think we can look to just within our own microcap universe. How many people have I had on that said, yeah, I went to the local state school, wanted to save up money. Didn't, I could have got into these schools, but I wanted to stay closer to home to save money, because they knew they had to get the degree to show something, but, went to one of these non-target schools and have still been a success today.
100% couldn't agree more.
Yeah. All right. My other question then as well is, you're letting the sun shine in a little bit on the magic here from Alta Fox. I mean, I'm just curious as to why you wanted to talk about this topic and really, showcase it more publicly.
Yeah, it's one, again, I think I've seen both sides, right? In many ways, I benefited from the traditional route. I mean, I checked a lot of those boxes and I've benefited from that. But I've also seen, a lot of candidates that went down the traditional path that look really good on resume who are, really bad analysts, right? And I've seen people who have gone down the non-traditional route who never really got a fair shot for some of the roles that they would have been really interested in, just because of this sort of arbitrary criteria. And I think that's unfortunate, right? Because ultimately you want a system where the best talent, right, it gets the seat, right? The person most deserving. I think that's clearly not the case today. I think yeah, I mean, I think it's a somewhat mindless system here where people just say, well, look, we want to have the best resumes, we want to have the best brand, and they're forgetting that it a lot more goes into it. And so if you can get somebody who's really passionate, like give me the guy from a non-target school who's read 10 years of Buffett, Greenblatt, Lynch, etc., and is super passionate about investing and is going to work their butt off, versus somebody who went to investment bank, right, went to a top school, but like has never opened up any of the Buffett partnership letters. Like, in my opinion, it's pretty clear who you want to bet on. And that's not to say, look, I think intellectual horsepower is important in investing. I don't think it's the only thing, right? It doesn't take a genius. We're doing mostly second grade math and the fundamental investing side, right? It's not that hard, but ultimately, I think it does take a desire it does take a passion for investing to be great. I believe that. I think, if you're really smart and, you work reasonably hard, you can probably do well, but I don't know if you'll ever be great. I think to be great, you really have to have a love for it. You have to sort of wake up thinking about it, go to sleep thinking about it. And there are a lot of those candidates that don't fit this traditional mold that aren't getting a shot. I think the industry's got to step up. It's got to do better. And ultimately, each firm is incentivized to do that because there are opportunities out there to hire great candidates that otherwise are overlooked.
I think I give you an amen to that right there. So we're about there. Any final thoughts on, I might as well ask you since we're here, any final thoughts on the first few months or 7 months of the year here? A little bit's gone on, and in 2 minutes or less. How about that?
Yeah, I mean, wow, what a roller coaster of a year, right? I mean, I don't think anyone saw this coming in. I don't think anyone would want this to ever happen again. I think there's been a lot of opportunities amid the carnage in March. You know, we were fortunate to capitalize on some of those, but there's still a lot of uncertainty, right? We're in an election year. There's a lot going on. There's a lot of civil unrest, as everyone's aware of, and the market's mostly taken this stuff in stride. We'll see. I don't have a particularly strong view on sort of where the markets on a high level sort of trend go, but what I can say is I'm still finding interesting sort of bottom up opportunities, specific businesses that are still trading at, I think, bargain levels. And that's what I'm trying to attack. But yeah, it's certainly been an absolutely crazy year. And, it's also a humbling, I think anytime you get this level of uncertainty and markets and companies are impacted by events you never really could have foreseen, I think it's a little bit of a humbling experience too, because you think you have control of the situation, and in reality there's a lot of things you could never predict. So I think you got to stay humble, you got to stay disciplined, you got to have good risk management. But I think there's still opportunities out there for investors who are willing to sort of go off the beaten path.
Agreed with you there too. With that, Connor, where can my audience go and find more information about Alta Fox and also follow you on social media?
Yeah, so the best place is probably just to go to my website, altafoxcapital.com. I can also be followed on Twitter. It's at Alta Fox Capital.
Perfect. Thank you so much for sharing your thoughts today. And I look forward to our next update.
Fantastic. Thanks a lot, Bobby.
Thank you.